Imagine waking up to headlines promising $2,000 sent straight to your bank account, all supposedly funded by tariffs on foreign goods, no extra taxes, no extra cost to you. It sounds simple, almost too good, and millions of people are already celebrating the idea. But behind that headline is an economic story that almost nobody is talking about, one involving inflation, federal deficits, Supreme Court cases, and revenue math that may not work out the way it's being advertised. Today, we're breaking down what this proposed tariff dividend really means for your wallet, your cost of living, and your long-term investing decisions. Welcome to Invest Education Hub, where we turn confusing financial news into clear insights anyone can understand.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's just jump right into the heart of this. The core promise, the thing that's got everyone talking, is incredibly simple and powerful. A $2,000 direct payment to most American adults. And we're not talking about some complicated tax credit you have to figure out next April or a rebate you have to apply for. The idea here is actual cash, a direct deposit hitting your bank account or a check showing up in your mailbox, just like those stimulus payments we saw a couple of years ago. So the very next question is obvious. Where is all this money supposed to come from? And the plan is really clear about this. It's going to be funded entirely by tariffs. Now, tariffs are basically just taxes that the US government charges on goods being imported from other countries. So the narrative, the story being told, is that foreign companies and foreign countries are the ones who are going to foot the bill for this direct cash payment to American families. On the surface, it really does sound like a perfect win-win situation. And this is the part of the promise that really makes you stop and listen. This is the hook. The idea that this $2,000 dividend arrives with absolutely no new cost to you, the American taxpayer. The argument is that since all the money is coming from these taxes on foreign goods, it doesn't require raising your income taxes or cutting other government programs that people rely on. It's being presented as, essentially, free money. So let's just recap. A $2,000 payment funded by foreign companies with zero cost to you. It's an incredibly attractive pitch. You can see why it's so popular. But, as investors, as people who really care about our financial future, we know that whenever something in the world of economics sounds that easy, that simple, it probably isn't. The real story, the one that actually matters, is always buried in the details. So let's start digging and break down the mechanics, the math, and the real-world consequences of this whole plan. All right, so first things first. Let's peel back that first layer and look at the promise itself. To really understand what we're dealing with, we need to go beyond the headlines and look at exactly what was said and what's being put on the table. This right here, this is the direct quote that kicked this entire national conversation into high gear. Now, what's so fascinating to me is the language being used. It's not, we're thinking about, or it might be possible to do this. The language is incredibly direct and certain. Will be paid. That's not typical political maybe speak. That's a firm commitment. And that level of certainty is what sets this apart from a lot of policy discussions. It creates a very, very high expectation. Okay, so what does that phrase, not including high-income people, actually mean in practice? Well, the exact rules haven't been laid out, but pretty much all analysts are looking at the last big stimulus payment from 2021 as a blueprint. If we use those income levels as a guide, we're talking about a massive number of people. Somewhere between 220 and 260 million American adults would likely qualify to receive this dividend. To put that in perspective, that is the vast majority of the working population. This isn't a small, targeted program. It's designed to hit almost every bank account in the country. All right, now we get to the engine that's supposed to power this whole thing. The entire dividend plan rests on one single source of funding: tariffs. But to really understand the true impact of this idea on your wallet, we have to ask one of the most fundamental and most misunderstood questions in economics. When the government puts a tax on imported goods, who actually ends up paying for it? If you look it up in a textbook, a tariff seems incredibly straightforward. A container ship full of, say, televisions from South Korea arrives at a US port. The government basically meets them at the dock and tells the importing company, hey, before you can sell these TVs in America, you owe us a tax. The company writes a check to the government, and the government collects the revenue. Seems simple, right? But, and this is a huge but, that's only the very beginning of that money's journey. The story does not end at the border. And this slide right here perfectly illustrates how that cost travels through the system. Think of a tariff like a new fee the government slaps on every single TV that comes into the country. So in step one, the electronics company that imported it pays that fee at the port. But that company is a business. Its job is to make a profit. So what happens in step 2? They pass that cost along. They add the cost of the tariff into the wholesale price they charge to retailers like Best Buy or Walmart. Now it's Best Buy's turn. They have to protect their profit margins. So what do they do in step 3? They tack that cost onto the price tag you see on the shelf. Which brings us to the final step. You walk into the store, you buy that new TV, and you, the final consumer, are the one who ultimately pays for that tariff. It's been baked right into the final price you pay at the register. Now we get to what I think is the most important part of this whole analysis, the money. Because political promises are one thing, but fiscal reality, well, that's a whole other story. Does the revenue that tariffs actually generate create enough cash to pay for a dividend of this enormous size? Let's run the numbers together. Okay, first, let's figure out the total price tag, the total bill for this whole program. You take $2,000 and you multiply it by our high-end estimate of 260 million eligible adults. The number you get is just staggering. It's around $520 billion. Over $500 billion. Just let that number sink in for a second. Okay, so that's the cost, $520 billion. Now let's look at the income side. Where's the money supposed to come from? Well, the plan says it's all from tariffs. The problem is, if you look at the government's own projections, the total amount of money they expect to collect from all tariffs for the entire year of 2025 is only about $300 billion. So you can already see the major issue here, right? The bill we have to pay is over $500 billion, but the money we have in the tariff piggy bank is only $300 billion. And to get the full picture, we have to add one more crucial piece of context. And that is that we're not starting this conversation from a balanced budget, not even close. After the government collects all of its revenue for the year, including those tariffs, it's already projected to overspend by $1.8 trillion. That's the federal deficit. That's money we're already borrowing just to keep the lights on, before this massive new spending program is even on the table. And when you lay these three numbers out side by side like this, the problem becomes crystal clear. It's just a simple visual math problem. Over here on the left, you've got the entire bucket of money coming in from tariffs. In the middle, you have the cost of the dividend, which, as you can see, is already way bigger than the bucket. And then towering over both of them, you have the existing annual overspending. The math just doesn't work. The proposed funding source doesn't even come close to covering the cost of the dividend, let alone making a dent in the deficit. Okay, so we've looked at the promise and we've looked at the hard numbers. And it's pretty clear there's a massive fiscal challenge right from the start. And hey, if you're finding this kind of clear-eyed, no-nonsense breakdown valuable, this is a great time to hit that subscribe button. We're all about cutting through the political noise to get to the financial facts that really matter. Because believe it or not, these financial hurdles, they're only the beginning of the story. So let's just imagine for a second that the math did work. Even if the money was there, the proposal would still have to navigate the incredible maze that is Washington, D.C. And right now, the road from a political promise to cash in your bank account is blocked by two gigantic challenges. One is happening in the courts, and the other is happening in Congress. This slide does a brilliant job of showing the two-front war this plan is facing. On the legal side, the very authority the president used to put these tariffs in place is being challenged right now at the Supreme Court. If the court rules against the administration, a huge chunk of that tariff money might have to be refunded to the companies that paid it. So, poof, the funding could literally vanish overnight. But even if the tariffs are upheld, you still have the second front, Congress. The U.S. Constitution is crystal clear on this. Congress controls the power of the purse. Any new spending program requires a new law. A bill would have to pass the House and get 60 votes in the Senate, which, given the huge price tag we just talked about, is an incredibly high political hurdle to clear. So, after all of that, the promise, the math, the legal battles, the politics, let's bring this all back to the most important question. What does this actually mean for you? For your personal finances, your cost of living, and your investments? How should you be thinking about this as it all unfolds? You know, we don't really have to guess what might happen when you inject hundreds of billions of new dollars into the economy. We just lived through a perfect and pretty painful case study. Remember back in 2021, those stimulus checks went out? It felt great at the moment. But what happened in 2022? We saw inflation explode to its highest level in 40 years. The price of gas, groceries, rent, everything just went through the roof. Now, were the checks the only reason for that? Of course not, it was complicated. But pumping that much cash into an economy that was already dealing with supply issues was a classic recipe for higher prices. This timeline forces us to ask that really tough question. Would a new payment just be a repeat of that same painful cycle?
For anyone who's investing for their future, this isn't about predicting the outcome. It's about understanding and managing the potential risks. First and foremost, you have inflation risk. That $2,000 check could easily be wiped out, and then some, by higher prices over the next couple years. Second, there's market volatility. These kinds of huge government proposals create a ton of uncertainty, and the stock market hates uncertainty. Expect to see big swings based on the day's headlines. And third, there's the direct impact on corporations. Tariffs squeeze the profit margins of any company that relies on imported parts or goods. But really, the most important takeaway is this: you cannot build a sound financial plan based on the shifting winds of politics. It has to be built on a disciplined, diversified, long-term strategy that can weather any storm.
And this really gets to the core of what it means to build wealth over the long term. In an inflationary world, which is the world we're living in, holding on to cash is a guaranteed losing strategy. It's like holding a melting ice cube. Every single day, the money in your savings account buys a little bit less. Savers get punished. The best defense, the only real way to get ahead, is to own things that are productive, to own assets that can grow in value and generate their own income. That means owning pieces of great companies through stocks, owning real estate, and having a stake in profitable businesses that can adapt to rising prices.
And so at the end of the day, this entire debate really boils down to this one single critical question. It's the central trade-off of the whole proposal. Is that immediate short-term benefit of a $2,000 check in your hand worth the potential long-term consequences of paying more for your gas, more for your groceries, and more for your rent? That's the real question that every single citizen and investor needs to be asking as this story continues to develop. Building wealth isn't about reacting to headlines. It's about understanding the truth behind them. If this video helped you see the real economics behind the proposed tariff dividend, hit like, subscribe, and share it with someone who's trying to make sense of today's financial news. Here at Invest Education Hub, we help you make clear, confident money decisions that protect your future and unlock long-term growth.